All right, Kev, it's time for us to talk about what we think is the most important event of the week. And really, I saw this great piece from JP Morgan, and it made me ask this important question. Who will be proven right? Will it be the mighty bond market or the stock market? And it was from Nicholas Panagritsoglou. I hope I pronounced that right, but
Well, I'm going to interrupt here. It was from when you were kind of going through with all your bearish buddies on Zero Hedge, right?
fair enough.
That's right. You found it on Zero Hedge.
I found it on Zero. Actually, I mean, I don't get J.P. Morgan shit directly, right? So, anyway,
Okay, go on.
Thanks for the public shaming, but let's move on. So he goes on. He goes that the relative signs of complacency, as he illustrates on that chart, kind of increase the likelihood or not likelihood, but increase the need to hedge their equity overweight. And what it really comes down to is that he observes that we've now gone down in the U.S. high yield credit market, the junk bond market. They're only pricing in right now a 6% chance of a recession, while the S&P 500 is down to just an 8% chance of a recession, while the bond market implied odds are still over 70% that there's a pending recession coming. And this is a huge divergence in my mind, and I wanted to pick your brain on this in terms of first of all, is this just the data being misinterpreted, or two, which market is getting this wrong? Like, what's going on? Like,
Yeah.
because obviously I'm a deflationist. I'm more in the bond market camp. I think that the bond market's right, which a lot of historians have always said the bond market's right, but it doesn't have to be the case this time. What's your thinking on this?
Okay, so the chart's a little complicated, and I do believe that there's a slight mistake. It says USHG credit. I believe he means IG credit, which is investment grade credit. And what you see here is the change from basically April 2nd from January 3rd.
Mm-hmm.
Okay, so what he's arguing is that the S&P on January 3rd was saying there was a 65% chance of recession, and they've now priced in an 8% chance of recession.
That's a pretty huge reversion.
For sure. And he's saying the same in investment grade credit. It's used to
No,
be,
high was it investment grade? He's talking high yield.
It's saying HG, but I think he means IG. So
No, but
there's
one
second. Let me go through it. So it's So let's go through it. So it's 55% down to 20%. High yield is used to be predicting kind of 30. It's down to 8. Base metals, it used to be predicting 60. It's down to 40. So all of them have kind of reduced the prediction of like the imminent recession.
Yeah. But one market didn't.
Which is the bond market. Now,
which is the 5 years where you trade on your on your.
So I think this is just
widening.
I'm a seller of this chart. I don't think this means anything. The Fed has gone and has staved off kind of an imminent recession through their change in policy. And in doing listen up.
All right.
And in doing so, they have caused a huge bump in risk assets, in investment. They've caused a narrowing in spreads on bonds. They've even caused a base metal rally. Now that might also be a combination of China, but in the meantime, yields have gone lower at various parts of the curve, and especially like the 5-year. So the 5-year is saying the yields have gone lower because there's more of a chance of recession, and therefore that's why the odds have gone up since then. I kind of think, what do you mean? The yields have gone lower because the Fed has changed its policy. Now, if you believe that the yields have gone lower because the Fed changes policies because they're so smart and they know inflation's coming, they know a recession's coming, then you go for it. You knock yourself out. But the rest of the markets, basically, this model is kind of crap, is what I'm saying. It's basically just looking at it's just looking at previous price movements in the market and saying this is what they're saying about kind of the probability of recession.
Fair enough.
So I just like, it's not telling you anything we didn't know. It's telling you yields have gone down and risk assets have gone up. That's all this is telling you.
But is that not a divergence?
No, because that's happening because the Fed has gotten easier.
Yeah.
So I guess it's a divergence if you think that the Fed's gotten easier and they know more than the rest of the risk assets. But I think the market is telling you that they.
But you really believe right now that just by Powell taking his foot off the brake, and just basically that in itself is more than enough to change the business cycle, and now we don't even have to worry about a recession risk. That this is all.
So here, So here's what I believe. I believe that at the very least, it's a possibility, and I'm not going to say
that's a cop out.
No, it's not, because if anybody tells you they know for sure. Whether they tell you they know for sure that we're about to go into deflation.
But that's just like a middle of the road call.
No,
it's a possibility.
No. But what I'm telling you is that if you're kind of listening to the market is telling you no. So you of all people, because you believe the market kind of gives signals through its price action. It's kind of ironic that you're that you're saying this price action doesn't mean anything and that you know better.
Well, I do know, but no, just kidding.
But listen. It could be. Listen, I understand the argument. David Rosenberg, very, very he's a very smart guy. He believes the Fed's tightened too much, that we've rolled over, and that there's nothing's going to change. Now, I have one question though for those who believe that it can't be changed and that we're about to enter into a recession. What if the Fed had cut? Would that have been enough to stave off a recession? What if they had cut by 50 or 100? So my point is, at some level, you have to admit the Fed has the power to stave off a recession. Or do you not believe that? Do you believe that the economy is going to roll over no matter what? No matter what the Fed does, the economy was going to roll over.
Maybe naively, I believe in the business cycle, and I believe that there are massive imbalances through a credit expansion that occur, and inevitably a recession is an incredibly important cleanse within that business cycle where all the misallocated capital gets thing. And so, to me, what I'm really hearing in your statement is the idea that if they move on interest rates, then all the misallocated capital, all the built inventories, all of these different things, that all gets pushed down, and it doesn't matter, as long as interest rates are a little bit lower, that the Fed is able to control all of this with their little magic behind the curtain levers.
Yeah. Okay, so listen, I understand your pushback, and you might not like it, and it might not be the right thing to do, but you have to admit that the Fed has the ability to extend the business cycle. Now
they attempt to extend it.
Okay. So do you think they don't have any ability to extend it?
No. Listen, I don't want to say something naive on the air like that their policy doesn't have an important influence. It does.
Well, that's my point. I don't know if this was enough to extend the business cycle, but I'm keeping my mind open.
What if their reaction is an admittance to the fact that the situation has already turned and that they would only accelerate the problem if they continued to tighten? Like, what if they just have already, behind closed doors, acknowledged that the crest has already been seen and that we're already over the other side and they are only going to damage things? Like,
okay, so listen, Patrick, I agree that is a possibility.
But you just don't think it's the probable thing.
I think you should keep your mind open to the
listen, as traders, we have a responsibility to keep our mind open.
Right. Okay. But the market is telling you that is not happening. Now, the markets get it wrong, so I'm not trying to say that I believe in the market because the market gets it wrong all the time. But I'm at least open to the idea that they have extended the business cycle much more so than the bears believe. And I don't know how much easing it'll take. Whether taking their foot off the brake is enough, I don't know. But I'm willing to look and watch and kind of get a feel for it. And the market is telling you, price action is telling you that it looks like it's enough.
All I have to say is that if somehow Trump finishes a 4-year presidential term without and having been able to somehow manage a way to have extended the business cycle that it didn't turn in his 4-year term, I think that would be incredible. I think it would be an incredible feat.
Okay, well, there you go.
And maybe we're in for some incredible.
Yeah. We've talked about this before. I believe that we're entering 99, 2000. Or at the very least, you should keep your mind open to that possibility. And
I'll tell you what, I'm going to start drinking your Kool-Aid when we're at 52-week new highs, but not a moment before.
Okay, sounds good. Speaking of drinking, I am getting low on beer. The sponsor didn't send us enough, so let's go on to the next subject.
Let's do that.
I'm going to run out of beer.
All right,
if we don't hurry it up.
There you go. So